Let's look at some important articles that I'm reading today. So the first article is from Stable Investor. How much corpus can you create using Sukanya Samriddhi account after 21 years? Sukanya Samridhi Yojana account gives 8.2% per annum. As per rules, the account matures in 21 years. Also, you can only make investments for the first 15 years. For the remaining 6 years, you cannot invest more, but your corpus keeps earning interest. And the maximum you can invest in a year is 1.5 lakhs. How much corpus can you create using Sukanya Samriddhi account after 21 years? If you are depositing 25,000 yearly, the maturity amount is 11.97 lakhs. And if you deposit 1.5 lakhs yearly, then the matured amount goes as high as 71 lakhs. That is depending upon how much you are investing per year. The total amount along with the 8.2% interest can go to 71 lakhs. Would this amount be enough for your daughter? It depends on each parent's view, but mind you, these figures are after 21 years. But even nowadays, good professional courses in India easily cost about 20 to 25 lakhs. And if you inflation adjust these numbers for the next 15-20 years, then the amount required for similar education will be a much bigger number. So chances are that the amount accumulated via Sukanya Samriddhi Yojana may not be enough. Also, there is a debatable rule which allows withdrawal up to 50% of this corpus for higher education. Solution: it's actually simple. Many of you already do it. If your daughter is still young and you still have 10 plus years before her higher education expenses begin, then you need to invest some money in equities. So this is the solution it is suggesting. Sukanya, no doubt, is a solid product, but it's a debt product which currently offers 8.2% interest, and many educational courses witness much higher inflation, at least in the pre-AI era. So, to generate inflation beating returns, you need to have some allocation to equities. So, this is what this article is suggesting, is to allocate some funds to the equity, not just save your money in fixed deposits or Sukanya Samriddhi accounts, which are essentially debt products. How much you should allocate between equity funds and Sukanya for your daughter's future depends upon your risk profile exactly. If you aren't conservative, then higher allocation to equity is better, assuming your daughter is young and you have several years before her higher education starts. A few suggestions: if you are ultra conservative, that is, you can't take much risks, then stick with 100% in Sukanya Samriddhi Yojana and PPF. So if you can take risks, then you should start investing in equity, and it takes time for equity to generate good returns. However, if you cannot take risks, then you should invest and should get invested in Sukanya Samriddhi and PPFs, debt products, which are risk free. If you only want to take limited risk, that is, you want to make a balance, then have 60 to 75% in Sukanya Samriddhi Yojana and 20 to 40% in equity funds. If you're moderately aggressive, then more than 75% can be put into equities. So it's a very balanced article which talks about, based upon your risk profile, how much can you invest in Sukanya Samriddhi and other debt funds like this, and how much you can actually get invested in equities. This is the next article that I really liked. So let's read it together. Trent targets 10x revenue milestone, eyes international markets. New Tata. Tata Group's retail arm, Trent, encompassing popular brands like Westside and Judio, we all know, is poised for significant expansion, with Chairman Neil and Tata expressing strong confidence in achieving a tenfold revenue milestone and venturing into international markets. So let's see the entire article. Tata Group retail firm Trent remains in the early phase of its growth journey despite rapid expansion in recent years, said its chairman Newell Tata, exuding confidence that the company would achieve its ambitious target of becoming 10 times bigger in revenue terms in not so distant future. So it's This is not a very small statement. 10 times in revenue means the company is looking to grow its size in 10 times in the near future. Let's see how the company looks to achieve this. Trent owns lifestyle and fashion department stores like Westside and value fashion chain like Judio and hypermarket Star Bazaar. Tata, in Trent's latest annual report, also said its future growth will continue to be anchored in building distinct, well defined proposition across categories while also aiming to take homegrown brands to international markets. So they are looking to go international markets and also across categories. Ambitious revenue targets. Referring to his remarks at Trent's 2023 shareholders meeting, Tata said he had envisioned the company becoming 10 times larger in terms of revenue with commensurate profitability. So, not only revenue that is going 10 times larger, but also profitability that will keep pace with the with the revenue. Since then, the revenue and profitability run rate have grown by over 2.5 times, right? So in 2023, when he first laid out his target of becoming 10 times larger, in the in the last 3 years, they have actually grown by over 2.5 times. Given all this, I am confident that we will reach the milestone I had referenced in the not so distant future. In financial year 26, Trent's revenue from operations was 19,000 crore, something to remember, and it operated 1,286 stores with a total retail area of 17.7 million square foot across 321 cities, right? Global, global aspirations and multi-brand strategy. Tata also underscored Trent's global ambitions, saying it would be enormously satisfying to build brands from India that achieve relevance across international markets. He said the company would aspire to generate material revenues from overseas markets, aligning with the country's broader objective of increasing value added exports. Yes. So they are eyeing overseas markets and value added exports. We should aspire boldly, execute with perseverance, and celebrate the pride of brands built ground up from India. The journey of Trent, which began 25 years ago by opening first store of West Side Commercial Street in Bangalore to over 1200 stores, which has been steady evolution. This was also supported by emergence of strong growth engines such as value fashion, format, Judio, and groceries retail chain Star. I have long believed that Trent is not intended to be defined by a single brand, but rather by a portfolio of brands. That's what they have done. Westside, Judio, Smart Bazaar, in a diverse, evolving market like India as well as globally. It is unlikely that any one brand can capture a dominant share of lifestyle space. Instead, Trend's approach has been to create distinct, well defined propositions that can cater to different consumer needs and occasions. This multi brand strategy will continue to guide our future. So, they are creating different brands to target different customers for luxury, and for luxury, they are looking at Website, and for price sensitive customers, they have Judio. Early phase of growth. Tata said the company is well positioned to build its existing platform, driven by strong ecosystem and a clear sense of purpose. Given the significant opportunities that remain ahead, the growing strength of Trend's platform, I believe we are still in an early phase of our growth journey. Reflecting on Trend's evolution, he said the company's journey began as a thoughtful transition from Lakme into fashion retail space and since has grown into meaningful business. He recalled early discussions with his mother, Simonette Tata, around reshaping Lakme's direction, guided by an aspiration to create products and experiences that people truly love and desire, while remaining rooted in Tata's values. It's deeply satisfying to see that in many ways, this aspiration has come to fruition through Trent's progress over the last 2.5 decades. The Tata Group had sold Lakme to FMCG major Hindustan Unilever in late 1990s. Pretty interesting thing to know. So it was a very well-rounded article, and I actually learned a lot about how Tata is looking to take their brands like Westside and Judio international, and that is the way they think they can achieve the tenfold revenue that they are looking. Now we will look at some international news to understand how the macroeconomy of the world is looking like. So this is an interesting article headline that I saw. It was about Wall Street bulls bet US stocks rally will defy bubble fears. It's an article that is about the bull run that is currently and will happen in the Wall Street, in the US stock markets. Investors and strategists shrug off worries that market could be overheating by betting on huge gains for AI-linked shares. Wall Street bulls are betting that a rally in US stocks has further to run, shrugging off concerns that huge gains for shares linked to AI are a sign that markets are overheating. So basically, they are saying that the market has still room to grow. There is more bull run to see than now. S&P 500 sailed to record closing highs 11 times in May, half of all trading days, leaving the US blue chip index up about 11% this year. Tech stocks have posted even loftier gains, with Nasdaq up 16%. First quarter earnings blew past Wall Street expectations, leading big banks including Goldman Sachs and Morgan Stanley to raise their S&P targets for the year in recent weeks. Many investors are betting that AI advances and huge investment in chips and data centers will turbocharge US growth and continue boosting companies' bottom lines. The AI economy that is getting built on and the investment that will go into chips and data centers. This is the main theme about this current bull run. We do not believe that we are in a bubble. A bubble would laugh at the valuations that we are paying right now. Steve Federal Home's Deputy Chief Investment Officer for Global Equities. Secular bull markets historically are 20-year events, and we think we are in the middle, and we think it's accelerating and the market can continue to go higher. Companies at the center of AI frenzy have posted eye-watering gains. Companies that are linked to this AI economy, this AI value chain, are posting very good results. The Philadelphia Semiconductor Index, which tracks big chip makers, has soared 81% since the start of the year, leaving it on course of its best run since 1999. So this is very bullish and it will continue to do. This is what they are saying. SanDisk, maker of data center storage products, have surged 600% so far in 2026, while other companies linked to AI, including Micron, Dell, Intel, Seagate, Western Digital, are up 200%. Nvidia, the $5 trillion chip behemoth, is most closely associated with the AI boom, has gained 13% so far this year. The rally in AI stocks has helped push measures of market valuations higher. The S&P 500 is trading at about 21 times expected earnings over the next year, over the 30-year average of 17. This is a graph that they have shown showing the forward P ratio. Forward P ratio means the forward profit that is expected out of companies. Based on that, if you judge the current price of the stock, so that's how it's different from the traditional P ratio, which is about the historical profit. So if you see that in 2010, it was the lowest of a forward P valuation for S&P 500, and now we can't say it's cheap, but it's around the historical high from 20 to 25. So it's not cheap. They're saying it's about at 17, and the historical average is about 21. Rising valuations and the speed of the rally have alarmed some market watchers, with Michael Burry, the investor made famous for his bet against the US housing market ahead of the 2008 financial crisis, warning repeatedly that Wall Street's AI euphoria resembles the unbridled enthusiasm of the dot-com boom. Basically, he's saying that Michael Burry, who has been a famous US investor who shorts based upon these overvaluation in market, he has repeatedly warned that this AI rally that we're seeing is the same nature of the dot-com bubble that happened in 1999 and 2000s, and the stock markets crashed. Paul Tudor Jones, the billionaire hedge fund manager, in a CNBC interview earlier this month, also described the market boom as a crazy time. If I had to pick a period, we have got another two to run. If you look at multiples and earnings, everything where we were in October, November of 1999. The Nasdaq's .com peak was in March 2000. But many investors say markets are underpinned by strong corporate fundamentals and expect advances in AI to be only in their early stages. Are these pockets of excess? Yes, there is a crowd going on. We can get 15 to 20% correction in individual stocks, said Mike Wilson, chief US equity strategist at Morgan Stanley, adding there will be frothiness and then correction, but the market can keep marching forward. Ben Snyder, chief US equity strategist at Goldman, added that conditions that typically mark the end of the bull market, such as speculative mania, contracting profit margins, or Federal Reserve rate rises, are absent. And that fuels my expectation that the recent market rally will continue. Some quantitative analysts similarly argue that a robust US economic and corporate profit growth suggests stock have ample room to rise further. There is a positive risk reward trade off in stocks, mainly around the fact that I think earnings growth is much more durable than people think, said Dennis Chisholm, director of quantitative market strategy at Fidelity, adding, I think that's the key to what I would call the secular bull market because it's the durability of earnings that justify valuations. Investors are also keenly awaiting a series of massive Wall Street debut in coming months that will test its appetite to absorb more AI shares. Elon Musk's AI to rockets company unveiled its initial public offering documents last week, where ChatGPT maker OpenAI and cloud developer Anthropic are also expected to go public. And this will be an important event to assess how far can this market absorb these AI stocks. The AI fever comes at a time when US stocks have overcome a series of hurdles that have prompted brief, sometimes painful pullbacks before climbing to new highs. The S&P 500 has jumped 57% from a low it hit at the height of the jitters over President Donald Trump's Liberation Day tariffs announced in 2025. It has meant that generally it has been far better to hold stocks through market reactions rather than either selling or betting against them. More often than not, you want to buy negative headlines, not sell them. This is a very good insight that I would say that do not get carried away by negative headlines. Most of the times it's a buying opportunity, not a selling opportunity. But it also needs great amount of research to understand if it's a buying opportunity or a selling opportunity. And for that, you need to be continuously connected to the market. And this is an effort to make sure that I am continuously connected to the market and I hopefully can help others. Now let's look at the next article. The next article is little cautionary. IPOs are no longer Wall Street's starting line, they are the exit ramp. Chart of the day. Wall Street used to get the growth story early. Now it often gets only the receipt. SpaceX is targeting public listing roughly 24 years after Elon Musk founded the rocket maker, underscoring a market shift that has pushed more company buildings into private markets and left public investors looking for wrappers, proxies, and ETFs to get in sooner. Basically, it's saying that most public companies or most companies that are building businesses are getting listed very late after the entire growth has happened. Earlier, the Wall Street used to get the growth story early. Now it is getting after 24 years after SpaceX has created significant amount of wealth over $1 trillion valuation. A chart of some of the past 4 decades biggest IPOs shows that SpaceX is on the tail end of the Wall Street norms. So earlier, you look at companies like Amazon, which got listed after 4 to 5 years, Netflix, Apple. SpaceX is arriving as a private market giant after years of growth funded outside the public stock market. This is a very different path from some of today's biggest public market winners. Amazon listed roughly 3 years after its founding. Apple and Netflix took about 5. Alphabet and Nvidia took about 6. The more recent crop waited longer. Tesla took about 7 years to go public. Meta took 8. Coinbase and Uber took close to a decade. Spotify waited about 12 years before its direct listing. Then there is a newer, long private cohort. Palantir waited 17 years before its direct listing. Reddit took 19 years. And SpaceX expected timeline would push even further, putting it closer to the far end of the chart than to the public market origin stories that created earlier generations of tech wealth. Palantir, Reddit, SpaceX, they are getting listed more than 17, 19, 24 years after they started their business, after the entire growth has happened. So the public investors, the retail investors cannot invest in these companies earlier and see the growth boom that they could have taken a piece of. These are two important asterisks. ARM most recently listed on Nasdaq in 2023 after an earlier public market run that ended with SoftBank taking the chip maker private in 2016. Saudi Aramco also depends on the starting point. Chart uses the 1988 creation of Saudi Arabian Oil Company. So after the company that got created in 1988, it got listed in 2019. So you can see Saudi Arabian Oil Company took almost 32 years to get listed. Still the direction is hard to miss. The IPO has become less of a beginning and more of a way for early investors, employees, and backers to cash out after years of private market value creation. So earlier, public markets were a way to raise funds to start a business, but today that has changed. Now it's just a dumping ground for the investors, employees, and venture capitalists to sell their fund, to sell their stake to public at large and exit from the company. So this is the trend that he's talking about, that IPOs are no longer the starting line. Companies are using it as a exit ramp. So very interesting article. So I hope you liked the roundup of the articles. This is an attempt to share my learnings to people at large. I hope it was of value. If you like this and want me to continue it, then drop a comment, share your feedback. See you next time. Thank you.